Hopes for rate cuts in Europe get a boost as one ECB council member eyes a cut in June and then one more straight away in July. Chinese industrial profits rise in April after weakness in March, and we take a look at the weakness in the Yuan and in the Philippine Peso. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Head of FX Research Mahjabeen Zaman reveals what happened to the US dollar in her study of the 8 Fed easing cycles since 1990.
So what we found in conclusion was really that the most of the dollar index decline occurs in the lead up to the first and second meetings.
But first, in 5 and 5 with ANZ. Global markets were pretty quiet overnight, with holidays in the UK and the US, meaning there was limited trading, ahead of key inflation data in the United States and Europe later this week. The Euro Stoxx 600 index closed up 0.3%, following comments from the ECB's French governor that consecutive rate cuts in June and July shouldn't be ruled out. Traders have been looking for clues for what might follow the widely expected first cut in June. In China, profits at large industrial firms rose 4% in April from a year ago, following a fall in March, which had led some to worry about the recovery in China's manufacturing, which has been relied on to offset sluggish domestic activity. Equipment manufacturing has led the jump in profits since the start of the year. The Aussie and Kiwi dollars were both up about 0.5% at 4 a.m. Sydney-Melbourne time at 66.56 US cents and 61.51 US cents respectively. The US dollar index was down about 0.15%. Number 2. But it has been US dollar strength in recent weeks that has been driving currency markets. Last week, Chinese authorities allowed the yuan's daily reference rate to weaken to its lowest level since January. ANZ's Head of Asia Research, Koon Goh, says factors other than the strong US dollar are also at play.
The Chinese yuan has been gradually weakening, partly because of the imposition of additional tariffs by the US on Chinese goods, and also concerns about potential escalation trade tensions between China and the EU, particularly after the G7 finance ministers' communique over the weekend, which singled out China for their industrial trade policies.
Number 3. The main focus for markets in New Zealand's budget on Thursday will be the amount of extra borrowing by the new government, says ANZ's New Zealand chief economist Sharon Zollner.
The market's main interest will be on how many bonds they're going to issue over the next while. That will, of course, depend on their revenue forecasts and their expenditure forecasts, both discretionary and kind of structural stuff they can't do anything about. We're picking a 10 billion increase. The range of expectations seems to be sort of 10 to 15 billion. So in terms of what that means for the market, it's like any other market. Really, the more you have to sell of something, the lower the price you're likely to get. And a lower price for a bond means higher yield. So that's why markets are very interested in that, because it could cause interest rates to move on the day.
Number 4. The Philippine Peso has been under further pressure in recent days, closing in on record lows against the US dollar. The US dollar was trading this morning at 58.1 peso. Now that's close to the peso's record low of 59 to the dollar back in 2022. It started the year at 55.4. Here's Koon again.
The reason for the weakness is because the BSP, the central bank, in their last policy meeting came out a lot more dovish than expected, with the governor flagging that he could cut rates twice this year as early as August. This is before what the market expects the Fed to cut, and therefore that has pushed the peso weaker.
Number 5. New Zealand monthly filled jobs data today is being watched for signs that the labour market really is weakening, something the Reserve Bank needs to help take demand out of the economy. Sharon says in recent months the data has been moving in the opposite direction to the official unemployment survey.
We'll be looking in this survey for those filled jobs to start to corroborate what the household survey is saying, which is certainly what we would expect to happen, maybe not this month, but over this quarter anyway, given the weakness in employment intentions and in anecdotes. Firms are not only less keen to hire, but obviously in some cases are actually letting people go.
Sharon Zollner there. Now, in our bonus deep dive interview, we talk with ANZ's Head of FX Research, Mahjabeen Zaman, about what happened to the US dollar leading up to the previous 8 Fed easing cycles since 1990. She says the US dollar does fall, but the effect of falling Fed funds rates does weaken as the cycle goes on?
So what was interesting was that since 1990, the first rate cut in all cycles had the largest negative impact on the US dollar, including, of course, the lead up and reaction to the actual meeting. We know that FX markets tend to be forward-looking and tend to move before the fact. But by the time we got to the final rate cut of each cycle, the dollar index was starting to rally after FOMC meetings. So what we found in conclusion was really that the most of the dollar index decline occurs in the lead up to the first and second meetings, particularly, and it's more pronounced of the easing cycle. And then overall, again, the bulk of the dollar weakness occurs before the FOMC meeting as well.
Yes, it's a fascinating chart showing the fall in the index in the 50 trading days before the FOMC meeting, which shows that there would be a fall. Now, assuming that we do have a September cut in the Fed funds rate, why haven't we seen so much of a fall yet?
I think there is a push and pull. I think at least for Q2, I think we are waiting to see, and so is the market in terms of what the full series of Q2 inflation numbers actually say. Obviously, the last number we got did show a little bit of moderation as opposed to what we saw in Q1. Now, if this continues, I think the interest rate expectations for rate cuts will start picking up again. Of course, this is not the only factor. We also need to think about what the Fed speakers say. Clearly, we see a little bit of a disconnect there. Some of the Fed speakers still remain pretty hawkish, and that's really sort of driving a little bit of that firmness of the dollar that we have seen so far.
Now, context matters in these easing cycles, and you've gone through the various easing cycles since 1990 to find which ones involved hard landings and which ones involved soft landings, just to give us a couple of scenarios to work with. And what did you find?
It was very interesting. We looked at rate cuts or Fed rate cuts under a hard landing environment. You know, some examples you could say, obviously, the GFC or the 2020. And clearly that was interesting because we saw initial weakness from rate cuts, but then we saw dollar rallies on haven demand. And so ultimately we saw a firmer USD at the end of it all rather than a weaker USD. However, when looking at environments where the Fed was easing and, we were in a soft landing environment, so some examples could be 2002-03 or 2019. In these situations, we saw the US dollar retain most of its weakness post the first rate cut and a limited degree of US dollar rebound before further dollar weakness set in. And this is where we are currently right now. We think we are in a soft landing environment. And as a result, we think the dollar will see a sustained decline into the second half of this year.
And the other variable in this situation is a presidential election due in November. How do you think that might play into the outlook for the US dollar this year?
This year's potential easing cycle, I guess, is further complicated by these US presidential elections. And we looked at elections starting from the late 80s up to 2020 and looked at reaction to, obviously, the outcome of each presidential election, and also whether at that point of time there was an easing cycle in play, a hiking cycle in play, or just the Fed was holding rates at that time. And, it was it was a little bit challenging. We really didn't find any clear pattern in how presidential elections impacts the US dollar, though if we do see a change in party, it does seem to generate some short-term USD upside. And so I think overall, given that we are likely to have seen perhaps the first rate cut before the presidential election this year, we still think that the Fed easing will be surely more pivotal for dollar's performance, at least up to the end of this year.
Mahjabeen Zaman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, May the 28th. Catch you tomorrow with Australian retail sales data and a look ahead to the Australian CPI numbers. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.